Thank you guys for all of your patience. We were just having a bit of an issue there. So just got that sorted. It was just an audio visual thing. So thank you for everyone who's been sitting on patiently. And now we'll just we'll jump straight into it to not take up any more of your time. So today, Angus and I will be, so Angus Geddes, the founder and CIO, obviously, and myself, Matthew Phillips, we're going to be going through the macro webinar. Just to get started, as always, a little bit of housekeeping. All of the information given today is on a general advice basis, so please check with your advisor before acting on any of the information or recommendations. And past performance is no guarantee of future performance. So thank you very much. All right, so we'll jump straight into this. Now, if you have any comments or questions on the right-hand side, you can see that. You just type them in there and we'll have a look, and at the end, we'll go through the Q&A. If you can't hear the presenter, so please play around with this or give us a call. So if they can't hear, just have a read. Thank you. Good. Okay, so we'll just jump into the market update. So Angus, thanks for joining us today. I'm sure everyone's very eager to get a bit of an update. I thought the one thing we could start off with is the S&P 500 this week.
Yeah, look, I think, you know, we've had this risk-on rally since the US election, and you know, the stock markets have really had a pretty solid November. In fact, one of the best months since 2021. And you know, we're certainly getting this Christmas rally, Matt, through into the end of the year, and there's a lot of expectation that you know, that Trump, when he takes office, is going to do a lot to drive the economy forward, and of course bring in tax cuts, reduce the amount of regulation, turbocharge the economy. He's pro-growth, pro-energy. So you know, essentially we're seeing, you know, a pretty strong finish to the end of the year, which of course is what we were looking for. Didn't think it would be quite this good, but nevertheless, we're seeing a very strong run into the end of the year, and we're seeing global stock markets follow the US as well. You know, as illustrated by the ASX 200 hitting a record high this week as well. So all things, you know, equal, I think, you know, it's going to be. We're probably going to see a continuation of this. We've got the Fed meeting a couple of weeks' time. They'll deliver a verdict on interest rates if we get another cut, and I think that'll sort of set the time. Now, you know, moving into next year, when Trump takes office, you know, the rally is becoming quite long in the tooth. You know, I made some key points this week about US exceptionalism and the fact that many global fund managers and investors now see the US as the only game in town. And of course, you know, I always get worried as a contrarian when markets become so one-sided like they are now. But you know, for now, you know, we were looking for this Christmas rally. We're getting it, and I think it's you know, it's going to be we're going to have a decent finish into the end of the year. A lot of Trump taking office and some of those initial changes he's going to put through are actually already being priced in now. So, you know, one question I have got, you know, this is for the new year, it's not now, is just how much of you know, all that sort of perceived productivity growth has been priced in. But yeah, we're getting the Santa rally in spades, Matt.
Yeah, perfect. And you talked about the Fed. The market seemed to be pricing in a 25 basis points cut. What do you think? You agree with that?
Well, I think, you know, the Fed's going to be data dependent. You know, the inflation numbers are showing signs of being a little bit stubborn, a little bit sticky. You know, the last mile, I suppose it always is. And there is some uncertainty now around what Trump's going to do on the tariff front and whether that could reignite inflation next year. But, you know, look, all things being equal, provided we get a benign payrolls number on Friday, if it's a blowout strong number, comes in massively above what the market's looking for in terms of new job adds, I think the Fed, well, that could give the Fed reason to pause. If the economy, is just running too hot, the last thing they want to do is juice it up too much. So I do think they are going to be data dependent, but importantly, they're going to be patient and take their time making more rate cuts from here on in. And I think the pace is probably going to slow, particularly with the uncertainty around Trumponomics and what that means. But all things being equal, we had we've had a decent rally in the bond market in the last week or so. I think we probably will get that rate cut in a couple of weeks' time.
Okay, perfect. And now look, with the S&P 500, it's obviously done fantastic, and we've seen a couple of those stocks doing a lot of the heavy lifting. What I'd like to visit next is the other end of town. So we've got the Russell 500, the Russell 2000 here. What are your thoughts on that? Are they going to play catch up?
Well, I think the case for the S&P 500 to keep advancing. We all know that for the last 2 years now, most of the heavy lifting, in fact, nearly all of the heavy lifting's been done by the Magnificent Seven. 7 companies that have really driven up the value of that index. So I think the heavy lifting now needs to be done for the bull market to keep going. Needs to be done by the other 493 companies in the S&P 500 and indeed the Russell 2000 small mid cap index. So in other words, we need to see the bull market really begin to broaden out, and for some of those laggard sectors and laggard indexes to play a role. Given that Mag 7 valuations are now at nosebleed prices. So we've seen quite a convincing breakout in the Russell 2000. It's broken out above that sort of big resistance level, which capped that index, for the last 3 years, and it's now testing the record highs in 21. So we could see a bit of backing and filling, but overall, I think the technical setup favours probably additional upside extension in this index, particularly with the US economy showing signs of resilience, and the Fed now beginning to cut rates, where small mid-cap stocks are a lot more sensitive to higher rates. So that certainly is going to be a tailwind. But yeah, technically, there's nothing suggesting that there's going to be a reversal in the US markets. All I would say is, if you take a contrarian perspective on where things are at, the US market is becoming pretty expensive compared to the rest of the world. And I'm beginning to see a lot better value elsewhere around the traps outside that US market.
Yeah, and look, that's a great point to go into the next slide, which is the US graph versus the rest of the world.
Yeah, I think the US stock market as a percentage of the world index is actually hit 70%. Is America really? Is it really? Is it that exceptional? Look, they've got a lot of companies that are doing a lot of amazing things, but there's over I think there's 7 billion people on the planet, 350 odd live in America. Is that stock market really worth 70% of the global market cap? It seems to me like we're getting quite extreme in terms of the way the US stock market's being priced and valued. And I'm not surprised that Warren Buffett, Berkshire Hathaway, is sitting on $350-400 billion of cash. He probably views it the same, that the markets are just getting ahead of themselves in terms of the way that they're pricing in future US growth potential.
Yeah, exactly. And I know you were talking about it in the daily today, which is the markets versus the GDP of the US, and how that's kind of been outpacing in terms of the GDP for some time, and we're starting to see that cross paths again. Did you want to talk to this?
Yeah, so this is quite an interesting chart. It goes right back to 1945 1945, I think. So that's not too good. Right back to 1945. Look, over time, a stock market will always more or less follow a country's GDP in nominal terms. Now, we look at Japan. Japanese stock market didn't do much for 2 decades because Japan had a lot of deflation and nominal GDP didn't do anything. And therefore the stock market didn't do much. So, over time, GDP or a stock market will typically always follow and track a country's nominal GDP. And in nominal terms, and also, also in real terms. Now, what is also obvious is that at certain times, certain periods, you'll get the stock market being priced well above a country's nominal GDP at a multiple of nominal GDP, and sometimes it's priced at quite a large discount. You'll always get that mean reversion, whether it's a bull market, a secular bull market that lends itself to the stock market becoming overvalued, or is it a secular bear market that lends itself to a stock market being undervalued relative to a country's GDP? You'll always get that mean reversion. And, I sort of tried to make that point this morning. So if I look at the world today, I look at the world's 2 largest economies, China and the United States. The United States has got about 27 trillion of GDP, thereabouts, which is roughly 30% of the global total. Yet its stock market accounts for 70% of total market cap. We look at China. China's GDP is about 18 trillion, so it's obviously less than the US by about maybe 9 trillion. Yet its stock market now is valued at a significant discount to its GDP. So, over time, we're going to see mean reversion. And I guess, this sort of really illustrates why we sort of think, Chinese stocks look cheap with a really relatively low risk reward skew, whereas, American companies, on the other hand, are very, very expensive, particularly Mag 7 names and the S&P 500. So, at some point we're going to get a reaction. I'm not saying that we're going to have a big sell-off tomorrow. All I'm saying is that the stock market over there is getting expensive, and there's a lot of other interesting value opportunities elsewhere in the world.
Yeah, and look, I know we've been seeing that quite a bit this week. Different commentators talking about how for the next 6 months, we do still expect those things to run, but after that, it would be a bit of a hedge and a bit of a smarter decision to diversify into probably some of the markets you've been talking about, so the UK, China, and Japan. And I mean, for Australia at the moment, we're just looking at the dollar this week, considering what happened yesterday. I think it was the lowest in about 4 months. This is actually the dollar yen. My bad. Sorry about that.
This is actually the dollar index, and yeah. The reason I have this slide in there, Matt, is because US exceptionalism is not just seeing capital flow into the US stock market. It seems like globally investors, all they want to do now is own American companies. But also the US dollar. We've seen the US dollar have this big spike up to sort of 107, 108. It has come off in the last week or so. But you've got to ask yourself the question, is the US really that good? They have got a lot of great companies doing really good things, but my word, are you paying for those in terms of valuation? Are you paying it forward? You're paying a lot to get that future growth. And I guess the question I'm asking is, is the rest of the world that bad to be priced that cheaply in a relative sense?
Oh, exactly, and look, so after that we'll probably pull it back to Australia. I was a little bit early on that chart, but we've seen the strength in the US dollar, and we've seen a bit of weakness in the Australian dollar. So looking at our markets, how would you be positioning the portfolio with this?
Well, the markets did not like the really meager growth that came through yesterday. You know, the GDP numbers were pretty awful. It really points to Australia teetering on the edge of a recession. But we have got some stabilisers in our economy, and because you know, we're resource centric, we've got a lot of resources, a lot of base metals and copper and gold and iron ore and energy. When the currency goes down, companies that are involved in those sectors in the Australian economy tend to do really well. So, you know, it was interesting that the Aussie dollar stopped at sort of 64 cents. I still think the Aussie dollar is looking oversold, but you know, it's 64 cents, and it's low for a reason, and that is, you know, the financial markets and FX markets are clearly worried that Australia could tip into a recession. So yeah, so the pressure is on really for the RBA to start easing. I certainly think that I'm not holding my breath like I was for a rate cut this month. I think it'll be but I do think it'll be a story for February, March, April next year.
Yeah, and I know there's going to be a lot of people hoping for that as well. So following the bit of the weakness in the Australian dollar, oh sorry, I thought we had. Yeah, we've got the gold story. So as you said, you know, this does help our miners and the commodities, and it's been a strong theme from you and for Prophets this year is that kind of growth and strength in the gold market.
Yeah,
do you think this still has time to run? I mean, look at that's fantastic.
I do. I think, you know, like I made this point a couple of times in recent weeks, but the resources sector is now trading at the biggest discount to the banks in about 30 odd years. And if we look at the domestic risks in the Australian economy, you know, with the likes of, you know, the retail numbers likely being under pressure for longer now, and the fact that savers are hoarding savings and they're not going out there and spending it. We've got a per capita GDP recession. I think I'd rather be exposed to the commodities and the resources sector at the moment than some of those industrials and stocks that are completely exposed to the domestic economy. So you can't really go past and ignore the gold sector at the moment. I mean, if you look at this chart, you know, the Australian dollar spot gold price is in this huge bull market. It's broken back above 4,100 an ounce, and it's reasserting to the top side. I mean, we could get new highs if the Aussie dollar were to weaken further, or if the US dollar gold price were to continue to strengthen. So, you know, it seems to me that, you know, the resources sectors looks cheap, but the Australian gold miners also look cheap. And, you know, we've had a decent rebound since that sort of sell-off that was induced by the Republican sweep at the election. I think that's kind of in the past now, and you know, the sector's going to reassert to the side. So no surprises, Matt, that, you know, Northern Star bid for De Grey and a $5 billion takeover. It's cheaper to go out there and buy gold producers, and I've been saying this for a long time, that Australian and indeed global gold miners and precious metal miners are cheap, and we're now really seeing that coming through in the M&A that's being deployed by some of these larger miners, where it's just cheaper to go and buy an asset rather than build it from scratch.
Yeah, exactly. And look, on that point, the next one we're going to touch on is Rio, who has, I can even see a question in here about Arcadia, and so the offer there to buy them. So again, not just in the gold sector, we're seeing this across the resources. As you said, you know, cheaper to go pick up stuff, and the lithium market's in a bit of a depression right now, so that's a good time to get them for cheap. You know, Rio's looking quite good. What are your thoughts? You think getting the diversification and their increase in copper and things like that, like we've seen. I think they wanted to get up to 40% more.
I put Rio up today. I just think, this is obviously a blue chip copper iron ore miner. Huge balance sheet, big free cash flows. This technical setup is pretty bullish. We like commodities, we like resources, and I think given that Rio reports in Australian dollars, the Aussie dollar at 64 cents, it seems to me like this is going to become quite a powerful tailwind for the sector. So yeah, I'm expecting quite a strong performance from the likes of Rio, BHP, the resource sector generally next year, and I think Rio's a good one to own, given that they've got a lot of copper production, and we're quite bullish on copper, and given the shortages that metal is going to have in the next 7 to 10 years, and Rio's well positioned for that. And again, like Northern Star launching the takeover for De Grey, we've seen Rio launch a bid for Acadium. Earlier this year we saw BHP launch a bid for Anglo American. So M&A is set to be pretty rife, and I think there's opportunity here in the sector. All of our portfolios, Matt, in terms of our SMA portfolios, have got pretty decent exposure to Rio and BHP.
Yeah, and I'm sure many of our members are in a similar spot. Okay, so look, we'll move on to the next one, which is James Hardie. I know you've been very bullish on this stock all year, and looking for the reduction in interest rates to help kick off the building industry, both here and the US.
Yeah, I think James Hardie. I put this slide up today because I wrote about James Hardie this morning. I think it's a fantastic way to get exposure to the dual housing markets in Australia and the US, particularly where there's a structural shortage of housing in both of those markets. For similar reasons, immigration, population growth, not a lot of construction activity over the last 10 years has led to a housing stock shortage. James Hardie is, they make fibro cement cladding that goes on a lot of these properties. A lot of these new houses is perfectly positioned for that. So I thought I'd put this stock up today because it's really well exposed. And don't forget that James Hardie generates a lot of revenue in the American market, and obviously with the US dollar strengthening against the Aussie, they're going to get a double whammy on the currency when they report earnings next year.
Yeah, perfect. Now, look, to switch back to the commodities sector, I thought we'd go to silver. I know this has been something that you've been going on about and being very very bullish on recently. Look, it's continued to perform.
It has, in the face of a stronger US dollar. The technical setup for silver looks really good, and we like commodities and resources generally next year, but I think silver really stands out. Throughout this whole sort of wave of US exceptionalism and US dollar exceptionalism, we've seen a bit of we've seen a little bit of profit taking, a little bit of corrective price action in silver, but it's found its feet pretty quickly, and it looks like it's gearing up for another rally in coming months. So silver's one to watch, as is copper and gold. But I generally like a lot of the a lot of the resources, and I'm even quite bullish on things like steel and iron ore. I don't think iron ore is really going to fall out of bed too much. It's probably only a matter of time before China has to do something quite dramatic in terms of stimulating their economy. And when they do, that tends to be very good for resources and commodities.
Yeah, perfect. And within the silver, for the research portfolio, so we do have a number of stocks in there. So we've got Fresnillo, We do have the SIL, the silver miner ETF, but one of the more recent ones that I know that you've been fairly hot on is Coeur mining. From our side in the research, this has only just come in, but already looking to perform.
Yeah, this is a classic contrarian stock, I think. It's had this huge bear market, and we're really seeing it pull up and break up and pull out of that range that it was trapped in for several years. And as we can see on this chart in front of us, the share price has converged within this this triangle range since the second quarter breakout. And I think, if anything, this is just a brief pause before a continuation of that uptrend. So I'll be looking for a retest of that big resistance level at 750 sometime in the next couple of months, and for Coeur really to retest those highs above $12 sometime next year. That's our base technical case, and the company's certainly got good fundamentals, and obviously if we're right on the silver price, that's going to be another powerful tailwind as well.
Yeah, it could be a fantastic bit of international exposure for some of the members over here in Australia. Brilliant. All right, so thanks for all of that, Angus, and we'll jump into some questions from the members now. One of the ones I've seen, I know you kind of touched on it briefly, is do we see the market coming off in January as we approach the Trump presidency?
Well, that's kind of my theory. The market is paying the incoming Trump administration. The market is paying that forward and pricing that now. And yeah, we know that he's going to be pro-business and it's going to be good for the economy. We know all of those things, but the question is how much is getting priced in now. So while I think this Christmas rally is going to continue into the end of the year and into the new year, people might start questioning how much of all that future good news around the economy has actually been priced in when he takes office at the end of January. So yeah, it's just something to be mindful of. I'm not saying that the US stock market is in for a massive slide, but it's been a long time since we've had some sort of correction. So I'll be revealing my baker's dozen predictions for next year, and one of those is probably going to be that the US stock market does have a correction at some point in the next over the next few quarters at some point next year.
And so there's another question here that kind of links perfectly with that. Is that would you be raising some cash for a possible correction?
Not yet. Not yet.
Yeah.
We're a week into December. This is typically a strong month after an election like we've just seen in the US. So, for now, rising tide lifts all boats. And, for me, I just want to get on the other side of December, see how the tape looks, how the price action looks. Secondly, I'm not too scared about some of the thematics that we've got in our portfolio. Obviously we've got in the contrarian fund, we've got gold, we've got a lot of Japan. Japanese financials are beneficiaries of rising interest rates. We hold a lot of those stocks in the SMA portfolios as well, so and in the international. And then we've got exposure to China, and again, we talked about the Chinese stock market, China Hong Kong stocks being really undervalued now relative to GDP, and I think technically both the CSI 300 and the Hang Seng, some of those other major Chinese indexes are in major early stage new bull markets. So I won't be rushing to turn those to cash. I also would say that European and certainly British companies screen pretty cheap, Matt. We're happy to own British Telecom at 8 or 9 times on a free cash flow yield that's potentially going to be in double digits with top line and bottom line revenue and earnings growth set to reassert quite strongly. So yeah, I'm not worried about some of the rest of the world. I don't think those stock markets are expensive. I'm just saying that the US stock market is looking pretty expensive. And yes, when the US sneezes, the rest of the world catches a cold. Maybe this time the US sneezes and we don't do much of a sneeze at all. I mean, who knows? But we are at some point. It would be silly not to expect some form of a corrective pullback in the US stock market.
Yeah, and one of the points that I saw you raise this week about China that I thought was quite interesting is that not just yourself, but a few other contrarian investors were thinking that there's not many sellers left in that market.
Yeah, good point.
Which is a nice turning point.
Really, really good point. When sellers get exhausted, selling gets exhausted, the path of least resistance is always to the top side. When there's no one left to sell, the path of least resistance is high. And I don't care how bad the sentiment is, how negative people are. You've just got to look at the price action and the tape will confirm that. And we're at that point now, I think, in China, Hong Kong. The big rally, Matt, that we saw in September, October, a lot of that was short covering. So, hedge funds that were actually short the market were scrambling to cover those shorts. They weren't going long, they weren't buying, they were just short covering. So I think the next leg higher will be the fact that there's just no more stock around. There's nothing really left, no sellers really left. And the last time we saw this was when the US stock market bottomed in October 22. And you might recall that back then no economist thought the US was going to avoid a recession. Everyone was convinced the US was going into recession, that there was trouble ahead. And the market went down 30-odd% that year and suffered quite a major decline. And it was at that point when the seller exhaustion set in that the bottom was made. So it's been pretty much up since then. So I'm looking for a similar sort of inflection point in China, Hong Kong.
Yeah, perfect. And that's quite a good one. I mean, we've got the Chinese ETF in the Australian report, and we've also got a number of direct tech and kind of large cap players over there. So I'm sure the members are looking hungrily at that. I've got a good one here, which is based on the GDP numbers that came out. So it says Australia's productivity is at a low. Is this going to impact the market? And should we look to diversify offshore, which you're kind of touching on at the moment?
Yeah, so look, the GDP numbers weren't great. They weren't great. And what this sort of says to me is that, the RBA needs to start easing and taking some of that pressure off the economy. And I think, that will be the playbook for next year. But, the fact that productivity is going backwards, the fact that we're letting a lot of people in, look, the economy needs it and we are growing, but we've got a GDP per capita recession. It's telling, and I think there's some issues that we've got that need fixing. One of them is the work from home. I don't think that does much for productivity. I know, Matt, that's probably not a popular view with a lot of people, but I'm not surprised with the work from home ethic that has become entrenched. Probably not as entrenched here as it is in some countries overseas, but it is relatively entrenched. I wouldn't be surprised if there's a big backlash against that next year. We would have had a backlash against the work from home already, but for the unemployment rate being low and the labour market still being too tight. So I'll say that. Secondly, yeah, look, discretionary retailers, and I think some of the industrials with direct exposure to the Australian economy Probably time to be a little bit cautious around them at the moment. I'm not saying to rush out and sell them. I'm just saying I wouldn't be buying them today. And, you know, we did talk about the resources stocks because they are, in a relative sense, quite well insulated against the US economy. In terms of what's going on in China and what's going on in commodity markets, impacts them more. And meanwhile, they get a tailwind with the weaker Australian dollar. But yeah, you know, the case is mounting for the RBA to cut rates sooner rather than later. And you know, if they don't cut and they hold rates too tight, they could push us into an official recession. I think we're already in a recession. It's just not obvious in the GDP numbers, but they are, you know, they are teetering on the edge. So you know, it is a concern. The other thing I'll say though, Matt, it is interesting that despite the fact that we are in a recession, well, we're teetering on the edge of a recession, the ASX 200 continues to make new highs. Now, the stock market is not the economy, and the economy is not the stock market. So, you know, it is interesting that that we've got this underway. And my personal view is that we can still be in a bull market despite the fact that the economy is floundering. And I think that's probably where this question was going. We can be, you know, having stagnant economic growth, but the stock market can be going up. Why? Well, you know, we've got pretty cheap values in the resources sector. And, you know, I think it's going to be the resources sector which makes up such a big chunk of our stock market that will really deliver that alpha and that outperformance in 2025. I'm looking for a big year in the resources sector. So that could be good for the stock market, even though the Australian economy may not really get going until the second half or even the fourth quarter of next year when those rate cuts finally begin to come through and have an impact.
Perfect. All right, Angus. Well, look, I think we're going to leave it there for today. Really appreciate everyone's time joining us. And Angus, thank you for all of your input.
Thank you.
And apologies again for the issue at the start. So
yeah,
enjoy the rest of your day, guys.
We seem to have a few technical issues, Matt. We're going to have to get our act together next time.
That's it.
All right. Thank you. Bye for now.
Thanks, guys.